Hey, this is Bobby Reynolds with Benchmark Home Loans, and you're listening to the Friday Tip of the Week. Today and then next week, we're going to be talking about credit score myths. These two sessions are summaries of a larger article that was published this year by Experian, who is one of the three major consumer credit bureaus. It was entitled Busting Credit Score Myths if you want to look it up, or you can just listen to the summary. The first myth says that there is only one credit score. That's simply not the case. Like I mentioned, there are three major consumer credit bureaus: Experian, Equifax, and TransUnion. All three of them will collect data on a person, and all three of them will collect various types of data, and then all three even use different algorithms to come up with a credit score. When we check a credit score here in the mortgage industry, we're going to take the three scores and we're going to take the middle one and use it as the basis for whether they qualify and at what kind of rate. But the truth is, all three scores are a little bit different. In fact, I learned recently that different industries will use a different scoring model. So while you may get one kind of a score if you're looking to borrow money for a mortgage, if you're inquiring about an auto loan, you may get a different score. Or if you're inquiring about insurance, or if you're inquiring for a credit card. So there are different scoring models. Now, even though there are different scores, they're oftentimes looking at the same indicators. They're going to look at things like how much, what's your credit limits do you have, and how much have you borrowed relative to those limits? What is the total overall amount that you've borrowed, and what has been the repayment history? Do you have any lates? They're going to look and see if you have public records out there like judgments, collections, or bankruptcy. They're going to look at the types of credit lines that you have used. And so those are all similar indicators that they're looking to determine our credit risk. Now, all that to say, there are more than one score. The second myth, though, says that your score is one of those things that is forever, and it's not. It's not a forever number. You don't have to think that, oh, I've got a bad score now, I'll always have a bad score. What a credit score is a point-in-time summary of your current credit situation. It's a point-in-time summary. It's like a snapshot. And if you've ever seen a snapshot of a person 1 year and then seen a snapshot of them a year later, you understand that changes can happen. In fact, credit scores can fluctuate quite a bit. In this article, they talked about how over a 3-month time period, 20% of consumers saw a 20-point swing in their credit score. That means that for 1/5 of consumers out there, in just 3 months, their score went either up or down by 20 points. Now that can be significant. The other thing that this noted was that, especially in an expanding economy, most people tended to go up. In fact, in that 3-month period, 30% of consumers went up to the next level of in terms of a credit score range. And if you expanded that out to a whole year, 60% of people actually climbed into the next range. I recently met someone whose credit score was nearly perfect, and when I told them that, they were like, wow, they were quite surprised. And I said, well, why? And they're like, well, if you'd known me 10 years ago and looked at my numbers then, Bobby, I wouldn't have qualified for you to loan me a piece of gum. I thought, but I also thought, man, this is a testimony to the fact that credit scores really can change. Now, next week, we'll look at two other myths, one of them having to do with the relationship of income to credit scores, which is interesting too. But for now, you guys have a happy Labor Day weekend. Drive safely out there. We'll see you next week.